All right, everybody. Okay, I'm going to go ahead and get started here. So today we're talking about year-end close. So there's a lot of things that can go into year-end close, but we're just going to discuss some of the things that you want to consider. Since it's that time of year, well, for most people, for anybody who's on a calendar year. So just a reminder about who we are here at Fourlane, what makes us unique. So we changed this up a little bit. If you've been on these webinars before, we changed it up slightly because one of the things that we realized, I mean, being the #1 QuickBooks Enterprise reseller since 2010 is super exciting, but we've been saying that for 12 years. So what really makes us unique and what we're uncovering, we uncover these things, is that we work with QuickBooks, NetSuite, Xero, and Acumatica. There aren't a lot of people who really work with all of those different products, right? So people can have options. What we do with these clients is if somebody comes to us from NetSuite, they say, hey, I want to switch into QuickBooks Online. It's usually what they say. And then I laugh, we all chuckle a little because all of us enterprise users, right? We know probably won't work out too well. But what we can do is when you switch out of a product, it's a lot of work. It's a lot of effort. So what we're offering is we can say, we can help you stay, right? Why do you want to switch? Maybe we can get it to work for you. Because most of the time, why people want to switch is failed implementation. So let's fix it. We're also ERP consultants maximizing QuickBooks. So for those people who do want to go to QuickBooks and have that ease of use and low price point, we will help push it to every boundary possible. Of course, we're accounting and software experts. We know both, and then we handle change well over here. We know how to get your team to handle change as well. So we're going to talk about year-end close today. We are going to go through how and what to look for on the profit and loss, specifically some little things like around fixed assets, prepaid, deferred costs, and revenue. We're going to talk about balance sheet reconciliations with and without statements. We're going to talk about creating a budget. I would love to know if anybody on the call has a budget. Do you guys create budgets annually? Would you raise your hand if you do? I would love to know that because we tend to see clients not budget as much. I would love to know that if you have budgets. And then we have set that closing date password. That's a quick little bullet point, but people often forget about it. Coming up, we have the QuickBooks Enterprise Future Courses. Next week, I'm going to be doing importing and updating lists. It's also one of those cleanup time of years, right? Then we're going to talk about all things journal entry. The week after that, and then the week after that, we have item categories, and then we'll slowly be rolling more and more things out. If you guys haven't looked at item categories since our 3 update in 2023, you definitely should. It's much better now than when I presented it back in September. All right, let's dive in product here. Of course, if you have any questions, go ahead and pop them in there. I'll get to them as I can. It's always a lot to cover. I always overtalk my 30 minutes here. So, okay, so let's talk about year-end close. So when you are, I mean, hopefully you're doing some of this planning before the year end, but right, it just hit January 1st. Of course, we'll go through some of the standard things, balance sheet reconciliation. You go in and you start reconciling your balance sheet accounts. But what I like to do, especially at year end, I mean, really you should do this every month, but especially at year end, because it's hard to get people to do this every month, we want to go through and review our profit and loss first, right, before we're reconciling balance sheet. Because when I go to reconcile balance sheet, I want to be able to reconcile the whole thing. So if anything's on the P&L that shouldn't be, I want to move it there first, then reconcile balance sheet, versus reconciling balance sheet, going to P&L and finding some things, then going to reconciling balance sheet again, right? So I start with P&L. Hopefully that makes sense, and you'll start to see this as we go along. So the way that I review profit and loss to see if there are things in there that shouldn't be is I will create the profit and loss statement, run it for the entire year, and total by quarter. Okay. That way, if something is really looking off, I can go down to by month, but taking it in smaller chunks, higher level initially, helps my brain not get too into the weeds, right? Because when I'm doing this review, I want to be able to recognize things from the high level as much as possible. I don't care about 50 cents. I don't care about 50 cents. So construction income. One of the things, I'm in a construction style right now, right? So you can see I'm looking at the trend. I had a 200,000, 227,000. That looks cool. A little bit of growth quarter over quarter, then a big drop. So maybe, you know, I don't know, it's too hot to build in the summertime. I'm not sure. And then they pick it back up in December again. Okay. So there's a couple things that tells me. One is potentially some of this number should really be back into this number. And so I might want to drill down and look at that, right? Because if our expectation is we have some growth quarter over quarter, definitely don't expect to have a huge drop. So probably that means that in these other attached quarters, something's sitting there. So I would drill into that. But because we're not talking about Q3 right now, we're talking about year end, I'm going to go ahead and pass on by that. And I'm going to go into reports. So in Enterprise, right, we have the job WIP summary report, which makes it a little bit easier, especially for contractor, construction, services type of clients. You can come in here and you can see our estimated cost, our actual cost, estimated revenue, earned revenue, and actual revenue. Okay, so it's saying that based on our cost percentage to what we estimated, that's how much we earned, right? 88.64% of our revenue is how much we earned, but we've actually billed out $2 million. So we billed out more than our estimated revenue. So we would have to make an adjustment of $386,000 to get into our earned revenue. Now, of course, with this being that it's 1.8 million and I have actual revenue of 2 million, I'm going to have to go back and look at why. Like, why is it over? Here's 205,000, but we've actually billed out 325,000 for this account. So I'd have to dive into the details here, but let's pretend that everything's clean. Then I would be using this amount, this $386,000. I would be debiting, right, my revenue account and crediting deferred revenue for that amount. Okay, so we want to look for any deferred revenue, and that's one of the ways that we can take a look at it. The other way that I see clients do that sometimes is they will go in on a job. You know, they might not use the WIP report, even though they probably should. They might go in on jobs and say, you know, I'm 50% done on this job, 20% done on that job. And so they'll do some stated versus actual. Yeah. But deferred revenue is something to keep track of. In the wholesale industry, sometimes where we'll see people make adjustments when it comes to revenue at year end is, you know, maybe if you have, especially if you're on an accrual basis and you have things on consignment, so they're showing up in revenue, but they're not really. So some people run it through revenues. So we need to back that consignment revenue out until it's actually sold. So we see things like that happening sometimes. Sometimes we'll see like a shipment out to, you know, Bed Bath & Beyond, a huge shipment out to Bed Bath & Beyond. But if that product isn't sold, we're going to be taking the hit on that. So anyway, we might push some stuff to deferred revenue there as well. Okay, moving forward into cost of goods sold down here. So I always, again, look at the trends. I see, you know, 2,500 drops down to 800, up to 6,400. So I would dive into this and take a look. at what's happening here, it looks like it's just one payroll check, and it's obviously a bonus check of some kind, right? So, okay, that's fine. My expectation is that that's not something that needs to be deferred. Now, wages, anytime we have wages at year end, we should be looking at the pay schedule. So if I come into my employee center and I can look at their paychecks, right, and it says, you know, 12/8, 12/22, so they're paid every 2 weeks. And then I would come down and say, okay, the last date they were paid is on 12/22. I know this is 2026, but let's pretend. Last date they were paid is on 12/22. And that would be, you know, for the pay period probably through the 15th. So the next time they're going to get paid is on the 5th. That would be for the pay period through the 29th. So I would need to accrue the entire payroll, right, from the 15th to the 29th that we're paying for. And then I'd also have to accrue 1 extra day to account for the 1 day that wouldn't be until the next payroll, picked up until the next payroll. So the way that you usually do that is, let's just take a nice round number and say that every day we have $10,000 worth of payroll costs. We would put onto the books, because the way that QuickBooks processes payroll, it picks up the expense when you process the payroll paycheck, right? Even if you're paying them for previous dates. So if it's a nice round number, I would be having to accrue for 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 days, so $110,000. That would go into expenses. So it would be a debit to expenses to cost of goods sold. If it was cost of goods sold, of course, if you have, you know. And then a credit to payroll accrual. Okay, you might have to split. What I mean is 110,000, you might have to split some of it to cost of goods sold and some to overhead. Okay. So be paying attention to payroll accruals that need to be posted at your end. Workers' compensation. So it looks like this is pretty steady. So nothing to have to worry about there, right? We're looking for trends. Usually the way that the easiest way to figure out if something should not be on the profit and loss is it's out of trend. Like workers' comp, if we pay them, you know, X amount per pay period, it should be pretty consistent month over month or quarter over quarter. Now, job-related costs down here, we have 38,023, then it bumps up to 120,000 when our revenue is dropping. None of that makes sense. That's not good. So I would be drilling down into this and looking at, are any of these not job-related costs? So all of them are job-related costs, right? They all are associated with the job. So then I probably wouldn't be paying attention to this quarter as much, although I might because it's such a high number, to see if any of these are prepayments, right? Maybe we have to prepay for, you know, the pool work or the plumbing work that's going to be done in January. Who knows what you have to do nowadays to get, you know, people to make sure they show up on the job sometimes. So maybe there has to be some prepayments happening. So we have to pay attention. Are any of these for prepayments? And if so, then they would come out of job-related costs and go into prepaids. Right? So it would be a credit to cost of goods sold and a debit to prepaids. Okay, but my guess is the answer is no in this case. Okay, then coming down below, so again, just looking at trends. One of the things is insurance auto here. I noticed that it's got 1025, 1025, right? And it has a gap quarter. So probably we got off somewhere, like maybe we pay them $1,000 a quarter and somehow the date or the timing of the bill or whatever got pushed out. So I would go and investigate that, because we shouldn't, like insurance doesn't decide to give us a quarter off. They're going to charge us, so we need to figure out where that went. Then I have a big jump up here in December, and any time a type of big jump like this in anything insurance, anything like professional fees, dues and subscriptions, right? So usually that means that we have some kind of prepayment happening. So in here, I can see that we have a $5,000 prepayment or $5,000 payment that came in at $1,220, and it's for the 2027 annual. So this should not be hitting my books in 2026 on the P&L at all, right? This should go, the entire thing should go to prepaid, because it's for 2027, which is the next year. So when I'm going through and cleaning up my books, I would be moving this up to prepaid insurance if we had it, but I'll just stick it to prepaid for now. Okay. So come entirely off of the P&L. Now you see why it's good to go through the P&L, because basically when I go reconcile my balance sheet now, I'm going to have a amortization schedule for dealing with that $5,000. Okay. Did I not move it? No, I guess I left it there. It's okay. Okay. Repairs and maintenance, I mean, usually, again, just something to keep our eyes on. Sometimes you'll want to look at repairs and maintenance on the annual, because if we did any major repairs or maintenance to vehicles, right, it should maybe not be hitting the profit and loss. It should be going in to fixed assets or to equipment. Right, so something to keep an eye on. But dues and subscriptions. So this is one where oftentimes, I mean, a lot of times people will do annual fees, right? And you get a discount if you pay that annual fee, or they'll do quarterly fees and you get a discount if you pay by quarter instead of paying by month. So dues and subscriptions is one that I always investigate with clients, and I come in, you know, double click, look through what happened there. You can see Salesforce hit in January for February through April. So I should have put this in as prepaid and put it through by month, right? So the $6,000 by month, as opposed to all of it hitting in one lump sum. But again, because I'm just focused on year end, I'm looking over here and I see that we have this last Salesforce bill, and it's for November 1st through January 30th. So I would need to split that, divide it by 3, right, and post 2/3 of it into this year and push 1/3 of it into prepaid for 2027. Also, you can see here the Value Builders annual membership. Now you have a fixed asset threshold. Usually that's a good marker too as well for if something should be amortized or pushed to the balance sheet. So in this case, $2,500 for an annual membership would probably need to be pushed to the balance sheet and amortized every month, right? Expensed every month. So this, instead of being in here, should be going into prepaids, and then we would do $2,200 a month. Now, if this was $250 for an annual membership, falls below the threshold, probably don't have to worry about amortizing every month. Okay. All right, so you guys kind of get the gist there of running through everything. So in one way, we're looking for annual memberships that should be, some of the expense needs to be pushed into the next year. Or sometimes too, you're looking on the front end, right? Like maybe, I mean, hopefully you've already filed your taxes at this point, but if, you know, maybe we have some expenses in January that came through in January that should have been pushed to the previous year as well. Sometimes you're looking at both. The other thing that we want to keep an eye on for is that fixed asset threshold. Is should anything that is hitting the P&L really be going to fixed assets? So things that we should be looking for, Computer supplies and equipment, perfect example. We open this up, it says this is computer supplies, 2 printers, and a laptop. So probably falls underneath the $1,000 threshold we have or whatever it is for fixed assets because it's 3 things we bought and it was $2,300. So I can bypass that one. Come down to office supplies. I always do a double click into office supplies and check through. Sometimes if they have a large amount in here, I will customize and filter for amounts greater than or equal to, you know, $1,000 if that's the threshold. Okay, and just one really needs to be a fixed asset. All right. Okay, so fixed assets is the second thing we're looking for. Then once we're done reviewing the P&L, right? So one of the things I always say is that if the balance sheet is right, the P&L is right. If the P&L is right, the balance sheet is right. So we feel like the P&L is pretty correct now. We reviewed all the things, pushed everything through the balance sheet that we think shouldn't be there. Now we're going to go through and start to reconcile balance sheet. So one of the things that sets QuickBooks apart from a lot of other softwares is because in other softwares, like Acumatica or NetSuite, there's a limitation for when I go to reconcile, I can only see credit card or bank account types in the reconciliation screen. QuickBooks is different in that you can see pretty much every balance sheet account on here. Like even retained earnings you can see in here, but it won't let you reconcile it. But I mean, you can see all the balance sheet accounts in there. So what the next step is that we're going to go through is reconcile each balance sheet account. So company checking account, we should be able to reconcile to a statement, right? Just like credit card account, we should be able to reconcile to a statement. The accounts receivable account, we should be able to reconcile to our subledger. Okay. Well, I didn't do it to the end of the year. Hold on. Customers, AR agent summary, do it to the end of the year. There we go. That doesn't tie out. 68,650. So that's how we substantiate that. Inventory asset, of course, we would be going in and doing our inventory valuation summary. So some subledger reports. We don't actually have to reconcile if we are doing some of these subledger reports. But then when we get into things like prepaids or customer deposits, as an example, we should be able to reconcile these and create the backup documents inside of QuickBooks. Okay, so the ones like customer deposits and prepaid accounts, we should always be reconciling to 0 because we don't get a statement from them. So if I go into banking and say reconcile and go to my prepaid account, here I would be beginning balance should be 0, ending balance should be 0, because what I'm reconciling is it came into this account and it left this account. So therefore it's 0. Then whatever's left over is what hasn't left the account yet. And I can review those and say, should they be here? What's their amortization schedule, etc. The next step is we reconcile the balance sheet. Gosh, I'm running out of time. See what I'm saying? Always running out of time. Once the balance sheet, we have a whole bunch of videos on reconciling balance sheet. So once the balance sheet is reconciled, the next step that we should be doing is we should be creating our budget. So I think a lot of people struggle with budget creation because they're not sure where to start. Creating a budget is really like putting a vision board out there, right? It's like, hey, this is what I think I'm going to achieve. And then we start to head towards it and see like, oh, can I actually achieve this, or is it not achievable? Do I need to? And in some cases, in like nonprofits or in some larger companies, budget is more fixed and has to be achieved. But at some point, somebody puts a number out there and says, I'm going to take ownership of this number. So how do we create budgets with our clients? Is we'll come in and we will, actually, let me take a step back. The most important thing is to make sure that your chart of accounts is organized in a nice, clean way. Because if you have a chart of accounts that's 400, accounts long, and it's not organized in buckets, then you're going to be, trying to create a budget for every single line. And sometimes that's overwhelming for people. They don't want to do that. So what we do with clients is we make sure that they're bucketed first. And then we look at like this fiscal year, and then maybe add in the previous year and see how much we've changed year over year. And then we'll collapse it down to look at it at the highest level possible. So we're looking at 1, 2, 3, 4, 5, 6, 7, 8, like 10, 12 accounts. Okay. And we create the budget here first. So I had 10% growth year over year. Next year, probably going to do about the same, 10% growth. Right. Cost of goods sold went down pretty significantly, 16%. Next year, we expect not to have a return or whatever it was, right, that made our cost of goods sold. So we would say, okay, well, we are expecting our margins to get better, not that much better, but better next year. So I would create a number. And then car and truck expenses, right, went up 152%. We're probably going to add another truck this year. So we'll add another 152% on this. So you just go line by line and compare. What did we do last year? What do we do this year? What was the percentage growth? And what do we think we're going to do next year? And usually I do this in Excel, by the way. And so once I get to that number, all these numbers at the line level, then I'll look at my net income and see, is that where I want it to be? And if the answer is yes, cool, we're great for next year in our budget. If the answer is no, then we need to figure out, do I need to add more revenue? Which if I add more revenue, there should be some cost of goods sold movement as well. Or do I need to eliminate expenses? And then if you really need to, you can start driving into the details, right? So we had 135,000 in payroll. Where was it? Oh, it was the owner. Not much I can do there. Okay. So next step with year end is to create budget. Now, a lot of times people will be creating budget in Q4 with projected year end values. Right? But then now that we're in January and we close out our year, we want to reconfirm that these budget numbers are what we're headed for in this year. Okay, and then the last step, of course, we go in there and we put our budget in the system. So we set up our budgets in the system, and we create a report so we can report against them in 2027. The last thing that we should be doing once we're done closing our year is going in to our preferences and setting our closing date password. A lot of times my clients will do this earlier rather than later, but coming in and saying, okay, 12/31/2026, putting a closing date password. Whoever has that closing date password can still post into 2026 and previous, right? It'll just show up on a report because they have a report that shows anything that used the closing date password. But we want to make sure to set that closing date. We want to make sure that someone else can't go in and modify our previous year period. Okay. All right, I kind of rushed through in the end there. If anybody has any questions, I'll hang out here for a second. But otherwise, I hope you guys were able to take away something that you're going to do differently in your year end. I didn't see a lot of hands raised for budgets. If anybody needs help with creating a budget, I know it's so daunting. Let us know for sure. We are great at doing that stuff with clients. Otherwise, I hope everybody has a great week, and I will see you all next week.